afternoon, everybody. Thank you for joining us today. I'm Danny Ratliff here with Richard Rosso and RIA Advisors. We have a special guest with us today. We're really excited about to share some information with you about family limited partnerships. We have Chris Masters of Doren-Mayhew. And so we're going to jump in today, little house cleaning as usual. We are a registered investment advisor for the Securities and Exchange Commission. So please don't take any of this as a personal recommendation. These are just information, educational purpose. Chris is going to share a lot of really good information around family limited partnerships, some other structures that potentially you and your family should be looking at to help protect you and your family from potential taxes, creditors, things of that nature. So want to jump right in. We try to keep these pretty light and pretty quick. So if you do have any questions, don't hesitate to ask in the Q&A box. We'll be answering those as we progress throughout the show or our time together today. Happy to address any of those that we can. And if not, we'll get back with you here shortly after. In an effort of talking about family limited partnerships, Chris put together a little diagram that will kind of take us through what people should be looking at, how you would typically do that. But really, Chris, who should be considering setting up a family limited partnership? This is generally typically a little bit more sophisticated type of structure than most people are probably used to.
Yeah, we have a real general rule that a family limited partnership is useful if the net worth of a couple is north of 2 million, excluding their house. That's kind of the beginning of the cost of preparing the return and the complexity of somewhat keeping track of what's in the partnership becomes beneficial. The underlying benefits of the partnership are asset protection and a few others, but really until you get to that level of wealth, there's not much need for it. Your personal residence in Texas is protected from creditors, and so you wouldn't put that into this. And that's just kind of a rough rule of thumb as far as who would benefit from creating this type of scenario.
This could be different in each state that you're conducting business in, correct?
That is correct. Yeah, each state is a little bit different. Family limited partnerships were created in Texas as a method to be able to reduce exposure for franchise tax. Then out of that, the limited partnerships here in Texas carry protections from creditors just through Texas courts. So each state has nuances of estate planning that are specific to that state. Some states might use revocable living trusts during their lifetime in order to skip things like probate. I know some of the big states like Illinois, New York, Michigan typically use the trusts as a method to skip probate. Limited partnerships aren't as frequent in some states as they are in Texas. So this is a strategy or a vehicle to really specific to Texas. However, the thought process behind the limited partnership is the same in a number of states. And so the benefits of the limited partnership when it comes to estate planning can be utilized really anywhere. Now, anywhere is a very general statement. Take it with a grain of salt and should always contact your advisors for depending on whatever state you're in.
Correct. So this is something you guys deal with frequently. And so that's why we have Chris here to kind of walk through the nuances of it, because in each state it is a little bit different. But with Doren-Mayhew, you guys operate in many different areas. How many offices do you guys have?
We have 7 offices here in the U.S.
This is something that you guys could potentially help with in a number of different states. So, and I know you have clients all over as well. But let's jump into the diagram, and then we'll kind of jump in. It'll probably spur some additional questions. And Rich, stop us or start us as we go. And talking about the benefits of this, and maybe some of the disadvantages and advantages here, Chris.
Yeah, absolutely. So many people have heard, if you're in Texas, you at the country club or the gym or dinner with friends, things like that, you've probably heard of family limited partnerships. The benefits of the family limited partnership are asset protection. The reason for that is under Texas law, the creditors are not able to obtain a charging order against the general partner interest. So what that is let's say you were to have a lawsuit of some sort, someone sues you and they are granted what's called a charging order, where essentially their claim can be attached to your assets. So think about a bank account or an investment account. A charging order against your bank account or investment account would require that advisor or bank distribute funds to the person who has that claim. And there's no protection against that. However, with a family limited partnership or just a limited partnership in general, the courts or the claim can attach to the limited partner interest, but they can't attach to a general partner. The key to this is, imagine you have a entity and that entity has numerous limited partnership interests. Someone attaches a claim to it. As general partner, meaning the matriarch or patriarch says, I'm the general partner, I decide to never distribute any money. By the way, I'm going to pay a management fee to myself for managing this partnership. And therefore, you can still get the money out of the partnership, but that claimant can't get anything for that limited partnership charge order that they got. So this just basically creates a method for you to not distribute money to a claimant and then negotiate a lower settlement for that amount. What we typically see is when people come up against a limited partnership in any sort of case, it just is a hindrance, and generally they will not try to go after it. So in general, there's a good amount of asset protection in Texas for the limited partnership, which is why people use them. They'll keep their investment funds in them. They'll keep bank accounts in them, that sort of thing. The other benefit is that the general partner doesn't have a designated amount of ownership that it has to have. So in many cases, the general partner will just own 1% of the company, and 99% of the company will be owned by either trusts, or it could be still owned by them or children directly, relatives, that sort of thing. But the key is that general partner controls all aspects of the company. So they're going to be the ones that make all investment advice. They're the ones that will make distributions. They're the ones that control tax returns and ownership documents and things like that. So you can maintain control of the entire company with just a 1% interest. So that's one of the big benefits as well. The expenses that are related to investments. So whether it's a ranch in South Texas, or it's a ski home in Park City, Utah, or a beach house in the Cayman Islands, whatever it may be that this partnership owns, expenses in order to maintain those investments are deductible through that partnership. So flights to Park City to check in on your investment, fencing for the ranch in South Texas, or just the overall property taxes for different properties aren't limited like they are on your 1040. They're deductible within this partnership. The other biggest thing for estate planning purposes is the use of the discounting. Some people might have heard of this, the DLOC, the discount for lack of control, or the DLOM, which is the discount for lack of marketability. And what this allows is, in a gifting scenario, because the general partner controls everything, those limited partnership interests have no control over the entity. So there's a discount for taking an ownership in a business that you have no control over. The other thing is, the general partner is going to have some sort of restrictions on who can own those limited partnership interests and where they can be transferred. So therefore, you have no marketability of that ownership. So once you own it, you can't just go to someone on the street and sell it, because the general partner is going to control that and not allow that. So there's discounts that are allowed for those, up to 20% typically for each of them. Depends a lot on the assets that are in the family limited partnership, what the total discount can be. But if you look at it from the standpoint of, I've got a $60 million family limited partnership and I can reduce it by 40%, that becomes quite advantageous for gifting purposes.
So the big thing is, I think that people need to understand, is the lack of control and lack of marketability are really what makes up a lot of this, that, is kind of forfeited in some ways, but also a big advantage in others from the protection aspect. And really, with the purposes intended here to protect the funds from the IRS and protect the funds from potential creditors, this is a big part of it.
That's right.
Let's jump into the proposed ownership structure and what that looks like, because this is where there's a lot of moving parts. I think it's where it can get rather confusing.
Absolutely. And so, a couple of the nuances of this, it is a company. You need to treat it as a company. It needs its own bank accounts. It needs its own set of books, which isn't difficult, can be done in Excel until you get, until the asset list gets longer, or, the activities in the company get longer. But you don't want to pay credit card bills and things out of that. You don't want to use it as a checking account. You have to treat it like a company, but it's pretty simple to do. So the scenario that we've proposed here is for what we would consider to be a taxable estate. So a taxable estate is an estate that's going to be over the lifetime exemption. The lifetime exemption per individual, just for ease, is 12 million per person. So for a couple, it's 24 million. So in this scenario, we're assuming that the family limited partnership would have a value of, let's say, 50 million. Okay. Then you're able to take the 40% discounts on that. You get it down to about 30 million, roughly. Then you're going to be able to use some gifting for 24 million. And then the remainder we're going to do through a note, and we'll walk through that. This is kind of very generally speaking. A couple of points as well. The family limited partnership, assuming a operating entity or a family business has the ability to be owned by a limited partnership, i.e. it's a partnership itself, or it's a corporation, or an LLC taxed as a partnership. If it's an S Corp, a limited partner can't own it. But the benefit to this is if you have real estate entities that are owned by the family, if you have operating business owned by the family, you can contribute that ownership into a family limited partnership and then utilize the discounting methods that we're going to talk about here. So in this case, patriarch and matriarch clean own 100% of the clean family partnership. The patriarch is a 0.5% general partner. The matriarch is a 0.5% general partner. And then the patriarch and matriarch both own equal amounts of the limited partnership as well. So they effectively own 100% of the entity. Sometimes you will have a 1% general partner that is a management trust so that it has continuation if the two die. There's many iterations of ways to do this. We're just showing a very basic calculation. So in this case, you create this family partnership. Let's say you contribute in the operating business, you contribute in real estate that it operates out of, you contribute in the ranch, you contribute in, vacation homes and investment accounts and whatever it is that you want to have in this. Okay. So now you have this partnership that owns all of these assets. What we would do is, let's say that the patriarch and matriarch have 3 trusts for their 3 children. Or they have 3 children. So they set up 3 trusts, one for each of the children. They can then have all of the beneficiary, restrictions that they want. The trustee, generally, they would be the trustee, or they might have a family friend or a brother, sister, maybe even a corporate trustee. At any rate, they then control the happenings within the trust, right? Now, these trusts, typically what we would say is they're grantor trusts. The grantor trust, we use those as another method of reducing overall estate tax, because with a intentionally defective grantor trust, the grantor pays all the tax. So essentially you've contributed the value into the trust, but the patriarch and matriarch still pay the tax, thereby reducing any further outside assets that it has. And the income in the trust can just continue to grow for the next generation. So in this case, that's how we did this scenario. They are, and we'll get to the reason why you would do a grantor trust as well. But so you set these 3 trusts up, and in the next slide, what we're doing is essentially taking the limited partnership interest, which totals 98%, and we're going to gift into the 3 trusts. So we're going to take an amount of 24 million. We're going to take 8 million of value, and we're going to gift it into each of the 3 trusts. Okay. So now the next step to this is on the next slide. In the case that I gave, let's say it was a $50 million total value in the family partnership. We've taken discounts to remove that down to, let's say, 30 million. And so we have a $50 million value, but we're going to gift it for 30 million. And then what we're going to do is take that remaining 6 million that we couldn't gift, and we're going to sell it into each of the trusts. So 2 million of value additionally is going to go into each trust for a note payable. So the trust now owes the patriarch and matriarch $2 million. Each trust does. So they have a note for 6 million. This allows them to get additional funds if they need it in life. They can have the assets of the partnership distribute to the trust, and then the trust can pay back the patriarch and matriarch in order to have cash, in order to pay taxes, whatever the case may be. But the reason we had grantor trusts is because essentially all of these items are still taking place on the patriarch and matriarch's tax return. So they essentially just sold this to themselves. So there's no gain on the sale. So you gift, and then you sell this at a higher amount than what it is, and you have no gain, no tax treatment of it. And effectively what we've done is we've just removed $50 million of value into the trusts for essentially a $6 million note. When the patriarch and matriarch pass away, all they have in their estate, assuming everything else has been liquidated, is a $6 million note. That $6 million note is going to be about a 10-year note at the applicable federal rate. So how much would somebody pay for a 10-year balloon payment note at the lowest interest rate acceptable? Generally, that amount is going to be much lower. So that $6 million note would probably get discounted to, let's say, $3 million in their estate plan. So in their estate plan now, you took $50 million, which normally subtract 24 would have left about $26 million of estate taxable value. And we just reduced that to $3 million. And so the tax on that $3 million at roughly 50% would be 1.5 million. So we just took this family and we saved them roughly $11.5 million of estate tax. So they went from 26 times 50%, 13 million, to 3 million times 50%, 1.5. So we took $11.5 million of estate tax off the table for them. And if anybody's ever heard of this or heard of somebody saying that they have to sell the family ranch in order to pay the tax, this is the exact scenario that stops that from happening, because now you can actually go get some life insurance. You can do other things to cover the 1.5, and the family gets to keep the assets and move forward.
We see this often with, it's a great example because I've seen that numerous times where somebody, they hold all their wealth in something that's maybe not a liquid asset, closely held businesses, the ranch, and on paper, they're fairly wealthy, but cash flow and liquid assets, it's not so much. And so this is a great way to help, navigate that and not have these same issues where you don't want to sell the ranch, right? Maybe it's been in the family for generations and generations, or the business. And this is a route around that. Now, we did have one question talking about, wouldn't the trust kind of dissipate the assets that you'd have to minimize that? But the trusts are really there strictly for the purposes of use and control and or, how you move assets, correct?
Correct. Yeah. I mean, ultimately, these assets are all going to still be in this same limited partnership. It's just that the owners are 3 trusts and then the 2 GPs that total 1%. So everything continues to operate the same way. The money earned from whatever investments there are uses to pay for the investments that are in there. And then the ownership is concentrated in those trusts.
So Chris, I have a couple of questions. So yes, like you said, it's still around this limited, I call it the limited trust, limited family limited partnership compound.
Mm-hmm.
The trusts are within that, right? So then the tax returns, will the trusts, all the income goes to the individual, the matriarch and patriarch, right?
Mm-hmm.
Under their taxes. So then there's also a tax return for the family limited partnership.
That's correct. So if you go to the next slide, once we've done what we just said we wanted to do, we end up with a scenario where this family limited partnership is still going to have a tax return. They're going to have a partnership tax return. And then you're just going to have these 5 owners. And the account, or the EIN, if you will, or for the 3 trusts is essentially a social security number for the patriarch. And so there's no extra tax returns for the upper level. It's just the one limited partnership return and then the patriarch matriarch tax returns. until they pass. And then at that point in time, the trust would probably become taxpayers, or, well, the trust would have a return, and then they would either give a, what we call a grantor letter to each of the beneficiaries, or it would become a complex trust, depending on the way they structure it, where the trust would then have a tax return and pay the tax. Just depends on how they want to set that up.
So this is a lot to digest. So,
Mm-hmm.
and it's great. I think the illustrations are really great. Maybe Danny, you want to get to some of the questions that are going along with this.
There's a couple of other things I wanted to point out from this.
Go ahead. Sure.
So the note would be secured by the ownership of the partnership of the limited partner. So let's say, for instance, no one ever has this happen, but let's say one of the kids goes off the rails, right, and becomes somebody that maybe can't be trusted with the money, or there's concerns, or just altogether is going to be cut out of the family for whatever. Those trusts are secured by the ownership in the family limited partnership. So for that note, they could just default the note and take back the ownership. So then the trust can sit out there. Now it doesn't own anything, and the matriarch patriarch can come in and take over that 33% again, and then either move it to the other trust. There's issues that relate to that. You've already used your lifetime exemption. You might have to sell the remaining piece, but at least you have the ability to take it back if you want it.
I think that, and that was a question I was going to ask you, because I think that's important, because you just never know, and have the ability to pull that back. Because even though there's only a small percentage interest for mom and pop, it doesn't have to be big for them to be the general partners. And then since they're grantor trusts, right?
Yeah,
they have that ability. Now, once, say for example, one child goes errant and you want a new trustee, can you then add another? We'd have to create a new trust, I guess.
Yep, you can
again, and then replace that interest right there in the for trust 3, say for example, or how does that work?
You can even do something, where, let's say trust 1, the person becomes, uncontrollable, or there's concerns. You can set up, even though the trust is irrevocable, there will be, facets of it that can be changed. And so you can do you can make changes to it to make it a special needs trust, where it has a corporate trustee and they purposefully don't distribute money because they think, directly to the person. They might pay rent for them, or they might, buy food and send it to them, those sorts of things. You can still make some changes to the trust. You just can't change, the large pieces to it. But you can still do protections, because they would be the trustee. They would have the ability to change the provisions that are allowable. In addition to that, if they just said, we don't want anybody to have this, then they can just foreclose on the note and call back their interest, create a new trust, and then sell that 33% into the new trust. You just need valuations when you do that. The other thing is, let's say all 3 kids are great. They've gone through college, upstanding citizens, all of that. And the trusts have actually paid back the $6 million that was owed. So there's no notes on it anymore. And then mom and dad find that they need money. Well, they can pay themselves a management fee for being the general partner and managing that trust. It has to just be, proportionate to the investments in the trust. But if there's a $400,000 or $500,000 management fee that needs to be paid in order mom and dad to have some money, then you can do that.
Talking about the structure and the setup. So with a family limited partnership, you historically have that general partner, then you have the limited partners. The GPs retain the control over the asset, so to speak. Is there any way to switch those out with other entities?
What do you just switch have the GP be an entity, or?
Yeah, no. Another question we had was that, can you use another entity as the GP versus just having the general partnership? Because historically, the reason you set it up the way you do it with a GP and an LP is for the specific control and the things that you just mentioned, because then you can make those changes along the way. If you had another type of entity, well, then it wouldn't work the same, correct?
It doesn't work as well. But,
okay.
For instance, I know in some other states, we've had people set up LLCs with 2 levels of, membership units, voting units and non-voting units. So, you can utilize some structuring there that allows people to still have control with all the vote. I've seen Some S corps do it, where you have S stock that is voting and some S stock that is non-voting. You just have, 50,000 shares of non-voting stock and 1,000 shares of voting stock, and the parents own the voting stock. I've seen it done in some others that just the S corps are pretty rigid in their allocations. They're not as flexible in the things that they do. You have to have everything's pro rata, regardless of voting or non-voting. LLC, you can have the different units, but I don't know that, it doesn't get away from the charging order benefits for an LLC. I think they can attach to anything, whether it's voting or non-voting. So you lose some of the benefits there. Just some nuances. I think if someone was gonna do that, it's a conversation with the attorney and the advisors to make sure that they're accomplishing everything they want to accomplish.
In this example, the children get the assets, but you can also set it up where you could have a charity or another organization or something else receive the assets upon, the passing, or I guess at the end of the trust or the end of the partnership, correct?
Yeah, absolutely. I've never, I haven't seen anything done that way. I don't see any reason why you couldn't have a donor advised fund take over some ownership of it, or some charity take over some ownership of it, or the only issue that I've got is the sale of stock, of the interest to like a charitable remainder trust or something. I'm not sure if we get, there would just be some nuances we'd have to work out. But yeah,
well, there may be more bang for your buck to do that outside of this partnership, correct? Where you just do a CRUD or a CRAT, charitable remainder trust or charitable, annuity trust, right? So it'd be a little bit different, correct?
It would be a little different. And really, this is very basic structure that we see. And what happens is we sit down and you really want to find out what are the ultimate goals of the family. What are the goals for the wealth, and how do you want it transferred, and where do you want it to go? And then, your advisors would work with your attorney and say, let's structure this so that we get, everything where we want it to be.
What if you own multiple properties, multiple vacation properties, investment properties? Would you keep them all under the same LP? They would just be under a series LLC or an LLCs themselves. How would you typically set something like that up?
Well, typically what happens right now, you would have, let's say you've got the Park City house in an LLC that's, Park City LLC, and then you have the ranch in an LLC or maybe in an individual name. You could leave them in their LLCs and contribute 100% of that LLC into the limited partnership. And then you would actually have an extra layer of protection from the property itself to the limited partnership, so that, people wouldn't be able to go from the one entity into the LP and back down into another entity to create liability. But you could just contribute the ownership you have in that LLC into the limited partnership. The goal here is to just aggregate the assets so that you can get the discounting benefit.
Rich, I know you've experienced a lot of people who having trouble with titling assets, where to put them, especially as wealth grows, and talking about, especially sometimes it's all at once. It's a liquidity event. It's a business you've worked in for a long time, and all of a sudden now you have this large amount of assets that you have to kind of start to work with. Where would you start with somebody who is just experiencing this, or maybe inheriting a large sum of assets? Rich, in your conversations with somebody, to kind of lead them down this path to finding out the best strategy and structure?
Well, it depends on a few things. You have to, this kind of structure, obviously, to Chris's point, you have this ranch, or you have this family business, and you want to pass it on to others and make sure that not only that it's protected by creditors, and you also want to make sure that there's a reduction. Someone asked, what's the benefits of a family limited partnership? Well, I also have reduction of estate taxes. Now, estate taxes haven't been a big deal based on how high the exemptions are. But Chris, by the end of 2026, when does the exemptions revert back? When do we sunset in the Tax Cuts and Jobs Act for when exemptions are lowered again?
Yeah, so this the current benefits of the lifetime exemption are going to go through 2025, and then they sunset. So at the end of 2025, it'll be roughly 13 million per person. Inflation adjusts the number annually. And then in 2026, the $13 million is going to go back to $6 million. So through 2025, the reason we're seeing this is we're seeing a lot of gifting. We're seeing a lot of moving of wealth prior to that sunsetting at the end of 2025, where right now by the end of 2025, you'll be able to give away 26 million. And then when you wake up on January 1st, 2026, that number will be 12.
And there's a real benefit to these, having the ability to have these valuations done and take an asset that would at death transfer at a much higher value, right? Because you're getting a valuation discount depending upon how you get it done. You even told me you can even get a valuation discount on cash, but you got to be careful of that on how it works. But so you have a professional, say I own, or I'm John Dutton and I own Dutton Ranch. I'm going to get a valuation on that Dutton Ranch, right? I'm going to get that. And then there's going to be a discount applied to that by moving this asset, right?
Correct. And there's a couple of ways that is done. The true valuation is done by an IRS approved valuation expert that uses the methods that the IRS wants. It's not the same thing as like a valuation for sale or what the market might really give you. It's really based on more fundamental numbers, look like property tax rolls. Real estate needs to have an appraiser that looks at it, but once they know what you're doing it for, it typically won't be this is the highest amount you could probably get. It's a very conservative, like tax roll type of valuation. Then you put all of those into the limited partnership, and then you get to take the extra 15 to 20% discount for each of the DLOC and DLOM. And so, like in my scenario, you take a $50 million value and you get rid of it for a much smaller number. That's assuming that the $50 million value is true market. It could be even 60 million or something along those lines if the property are valued that much higher. Like a lot of times what we see is, for instance, like I mentioned, the South Texas ranch, maybe there's oil wells on that ranch, and then you get, by the time it comes to us, there's all the depletion discounts and the runway for the well and valuation discounts by the time it even gets into the limited partnership, and then gets discounted from there. So the other piece to this is 3 years from now, the value of those assets could be even higher.
Well, thank you for that. And the one thing, and then just to circle back to what Danny said, if someone I was thinking about the person who won that $1.2 billion lotto.
Yeah.
I'm not going to talk to my financial advisor first. I know that sounds terrible, me being a financial advisor. I am going to I'm going to knock on Chris's door. I want a tax specialist first, because it's not nearly bad. I mean, investing the money is going to be easy. Putting structures in place to minimize estate tax, making sure that it protects my family for generations and creditors, that is going to be the most important decision I am going to make on a large inheritance. Like Danny, we always say, like, everybody always wants to know which stock to buy, and that's like the icing on the cake. I want to get into the batter first, and Chris is batter. I won't call you that to your face, Chris. I won't call you batter, but I want a tax person first, don't I, Danny? I want a tax strategist.
Yeah, absolutely.
I want my financial advisor to be there, but I want my tax strategist to make sure that I keep as much of this and my family keeps as much of this as possible. But I am going to buy that 1977 Elvis Presley Cadillac. I'm going to do that.
There you go.
First.
Well, we get a lot of those calls a lot of times first when somebody is going through one of these bigger events. And so typically we're going to say, hey, you need to call Chris, you need to call the attorney, and we'll set up a meeting together and visit and determine, what's the best way, what are your real intents, your objectives for these funds, how do we protect them, how do we keep that legacy intent alive if that's what the case is. And, we talk about minimizing taxes on a regular basis. And this is one of the things I think is difficult because it is a little bit more time consuming. There's a little bit more sophistication towards it. There's more requirements associated with it. You have to run this like a business, right, Chris? This is going to entail having a board, having regular meetings, documenting them with meeting minutes. It's a little bit more than what most people are used to.
Yeah, and someone just brought this up about a question about how much does this cost? And I will tell you, there's a cost, right? Because you're going to want to make sure you have qualified tax people, making sure you're doing all the right things. So it's not only a cost of money, it's cost of time. But if you look at ultimately how much you would save in estate tax, depending on the size of your estate. It's worth the annual cost for what you're going to save. So Chris, I don't know, I don't want you to share anything obviously confidential, but give me an idea of like how much you've saved in estate taxes for certain families based on what they're going to pay annually. Because I wouldn't want to do this myself. I'm going to hire Doren-Mayhew to do this. I don't want I might keep records.
Yeah,
but I'm going to have you do all the dirty work. I want to make sure that I'm not going to get, because I can get audited real easily. If a qualified tax person is doing this properly, I have less chance of an audit, most likely.
And
So,
there's, this is, like I said, this is a very basic kind of presentation. There's little rules that I didn't get into to kind of stay out of the minutia, like the gifting into the trust. There has to be value in the trust in order to make the note a viable note. You can only do the note 10 times the amount of the assets that you put in the trust is kind of a rule of thumb. So, let's say you gifted 8 million to each of these, but let's say the overall family limited partnership is 200 million. You could only do a note for 80 million based on 10 times the amount that's already in there. So there's nuances to this that need to be, vetted. The cost to this depends largely on the size of the estate. If you've got 4 or 5 million, you want to set up a family limited partnership, it'll probably cost you $2,500 in legal fees to work through it with your attorney. That might even include some of the basic trusts. Maybe it's another $2,000-3,000 for the trust to be set up if they're all the same. And then you're looking at a partnership tax return that might be $2,000, something like that. As you get more complex, I've got a client, we just did one of these for about a $70 million family. So, by the time the trust was created and the gifting went into it, it's got about a $70 million note and this is when the AFR rate was 1.8. So it's got a 10-year note at 1.8%. And so we essentially reduced the estate tax by about $33 million. So it just took, and it's an elderly couple. And so for them, it was a realistic, like everything we've worked for would be sold and gone. And so by doing this, it, created continuation for the next generation. And
I want my family to have that $33 million for whatever it costs me every year versus the government based on how we see how they spend money. Take a look at the Inflation Reduction Act.
Right. The other thing too is these trusts, the trust can be set up as generation skipping trusts. So you can actually, whatever stays in the trust doesn't get included in that next generation's estate either, and would then go to the following generation. There's also, there's a number of trusts like dynasty trusts and things like that, where each generation can only take out 20% of the principal, or, there's, depending on the size of your estate, there's a number of things that can be done based on what you want. So the biggest key would be sit with your advisor, your financial advisor, your legal advisor, your tax advisor. I recommend everybody be in the room. Everyone's going to have an opinion. You can vet everything that you want to do. There's a lot of, and with the opinions, there's good things. I tend to tell my clients that in your trust, you shouldn't, you should give the money or distribute the money from the trusts at ages 40, 45, and 50. Some people want to do it at 30. I say you're a different person at 25 than you are at 45. So, if you're trying to protect them, then, that's what you want to do. Everybody's just got an opinion on those things, and it's good for all of your advisors to sit and talk through all of the options, and then you can make an informed decision.
I have a lot of clients come to me and say, hey, my kids or my grandkids said I need to go set up this trust for this family limited partnership. And sometimes they have like $500,000, $1 million. In that aspect or that instance, it's probably not worth it, correct?
Yeah, I don't think that's really, like I said, you're going to pay about $2,000 to do annual tax returns and things like that. And you're going to spend another $5,000 to set stuff up. And you're not saving that much. There's not the need for the complexity at that point, unless there's something they're afraid of, I guess. But there's not a real need until, like I said, that around the $2 million range of net worth is where it becomes valuable.
Most important
Yeah,
though, is
good.
regardless of that, I could have $500,000. I could have $1 million, but I still got to make sure that I have an estate plan. I got to make sure I have my wills. I've got to make sure my beneficiaries are proper. I have my HIPAA releases, my powers of attorney. So, it doesn't circumvent the fact that you do need estate planning of some kind. But to your point, you're not going to need this kind of sophisticated structure put in place. But for people that do have farms and ranches that need this kind of help, this is indispensable to
I have
them.
seen them, I say that 2 million is kind of the general number. I've seen them at smaller numbers. If you have families that, let's say patriarch and matriarch don't have any children, but they have like 12 nieces and nephews, that sort of thing. We see people set these up to, disperse to 12 different people. That way they're not fighting and, that sort of thing, and not just liquidating, because you might have one niece or nephew who's 2 years old and another one that's 20 years old, so we see when you have disparity or there's a reason, we do see them in smaller amounts when it's like, we want to treat all of them equal, but they can't yet be treated equal, kind of thing. But to some extent, you can even do that in your will. In your estate planning, you can set up a will that'll create a trust for everybody, and the money just gets dispersed upon death into those trusts. So, there's a lot of methods to do it. I think the biggest benefit for this is if you have a reason to have asset protection and you're looking for ways to take a taxable estate and reduce the tax on that, that's where the benefits come from.
Well, Chris, you just brought this up for that $70 million family. If say they didn't do this, then they had to come up with $33 million. You've got illiquid assets. I'm gonna have to sell them at a discount if I don't have the proper insurance. The government wants their money.
Yeah.
You could really put the whole generational family ranch or business in complete jeopardy.
Right.
Without something like this in place, if you're subject to the estate tax. So that's where this is incredibly instrumental.
Yeah, the small amount of time and the small amount of money compared to what it would cost at the end of the day is almost inconsequential. You're really doing a disservice to your family by not doing something like this. So before we wrap up, rather specific question, Chris. And so how do you avoid the requirements of Section 2036 issues? When you retain some incidents of ownership, you can enjoy it, maybe it produces income. Is that something that you need to be concerned with when you have one of these?
It is. There's a little worry about the clawback, the ability, no strings to the true gift. We do see a number of times where the patriarch and matriarch wouldn't be the trustee of trust 1, 2, and 3, just to give that perception of not, having their true, no strings. So we will see that, trust 1, 2, and 3 might have an uncle or a brother, like I said, that has the trustee. That being said, they can still be the investment advisor for the trust. But there's little nuances in the actual setup to make sure that we don't trip any of those rules.
So before we tie this up today, you guys have any parting words for everybody viewing this?
I think that if there are people that are sitting in on this, that this doesn't apply to them. That's okay. What you are doing is getting a general awareness of different estate planning techniques and may get you thinking about your own estate plan and what you haven't done. And I think that's important. For people that have family businesses and ranches and haven't done this kind of structure, it's at least something that you want to explore when you have an illiquid asset and you want that asset to continue in the family. So that's where this is also very important to analyze. So I think regardless of your overall net worth, this is an important presentation because it'll spark something in your head that says, I need to do something on the estate planning side that I haven't done. So overall, I think just the perspective of this, the reason I thought this would be a good topic, especially with Chris, is that I think people are sometimes scared of these things. Even people that have high net worth, they build these wonderful legacies and all that, and they're still scared of these things because they hear stories that the IRS is targeting them, or, oh my God, it's so much work, and they're not, you broke it down very granular, and somebody like Chris is designed to make it easy for you to understand why you're doing this. And then comes back with the bottom line number that you just saved X amount in estate taxes. And not only that, ensured that this asset continues way long after you're gone. So I think regardless of who you are and how much you have in assets, this is an important presentation, and the importance of having a tax specialist on your financial team is crucial.
And I would echo a lot of that. I think the biggest takeaway for me is, there was a comment in here, you better have a good tax attorney. Yeah, you should. People always ask, what are the things that the richest people in the world are doing that I'm not doing, that I need to do? These are the types of things they're doing. If you worry about, is this an acceptable transaction? Is this gimmicky? Is it, this and that? In one of the bills that was trying to get passed last year, if you remember, they talked about trying to get rid of the lack of control discount, the lack of marketability discount. They know this is out there. They know this is a very commonly used estate planning tool. That's why they tried to get rid of some of those items in order to make it a little more difficult. And while you might not be in a taxable estate today, you may be in 3 years. And so you have a window of time to look at where you are and what you're doing and make some planning for the future. It's a difficult conversation talking about your personal death and what's going to happen after you pass is always a difficult thing to do. And you might like one kid more than another right now, and you might not know what to do, or you have one that is going to take over the business and another one that's exploring theater in Los Angeles. Who knows? It's just a matter of, I always feel like making a game plan and executing towards that plan is going to be more productive than just hoping it works out. So as you're looking at this, get a good team, get your advisors together, make a plan, and don't be afraid to tackle this type of situation.
I have found the key to immortality.
What's that?
If I have a good estate plan, I live on because I am considered favorably. I took care of my family properly, right? I didn't cause any bickering among my family. In other words, I live on through a good estate plan. I am going to be very well remembered for a rotten estate plan if I don't do it properly, right? When Aretha Franklin died, right? She had no estate plan. I know it's crazy. She had all the rights to all this music and she's a genius. She had nothing, right? And they've had to have something like $50 million in estate taxes. Okay. Am I, the son or the children, going to remember her for her great music, or that she was a jerk for not doing estate planning, right? I mean, you live through your children through, wow, mom and dad took care of me. I'll never forget this. I have a responsibility. I just think that you should embrace the estate plan because it's how you live on by the smart decisions you're making right now.
There's an interesting point about that too. When you don't have an estate plan, especially like Aretha Franklin did, that everybody sued everybody, and the taxes were still due. And so they didn't have any money because they didn't know who was getting anything. And it was a mess. And so
terrible story. Terrible.
Crazy. It was crazy.
That was one of the worst examples I've ever seen, or even horrified me.
Yeah.
That with the amount of money she had, that there was no preparation.
Absolutely.
Yeah, unfortunately, that happens all too often. So, guys, hey, if you have questions following up with this, please let us know. We love working with Chris Masters and Doren-Mayhew. They're CPAs, but they're also advisors. And I think that's the key here is that, do you want somebody to do your taxes and fill in the blanks, or do you want somebody to give you advice and give you direction, not only on how you preserve, protect, and not pay as much taxes now, but also into the future, which we think is so important, especially in light of potential tax changes in the future. So thank you guys for joining us. Please don't hesitate to go take that survey. Let us know if you'd like somebody from our team or Chris's team to reach out to you, set up an initial consultation, see how we can help. And Chris, thank you so much for joining us today. Look forward to doing more of these with you in the future. And it's a great wealth of information. We appreciate it.
Absolutely. No, I appreciate it. Thank you very much. And hopefully everybody got something out of this to take with them today. And Happy New Year to everybody.
Yep. Happy New Year, guys. So, hey, if you are just finding us or you haven't heard much about us, go to realinvestmentadvice.com. You can check out our daily information. We have daily market updates. We have information coming out to you via our newsletter, podcast, radio show here in Houston on AM 700. And first and foremost, I think is really important we'll finish up with this, is that we are fiduciaries and we take this not lightly at all. This is a very important thing to us. Your holistic well-being is extremely important to us as far as how we operate, what we do. So give us any feedback, any other topics you want to have Chris back on to go over. We'd love to hear, and we'll talk to you soon. Thanks for joining us. So have a great day.